Silver at $130 an ounce. That's what some dealers in Tokyo are reportedly asking physical buyers to pay right now. Not futures contracts, not paper silver, physical metal in your hand. And if that number just made your heart skip a beat, you need to understand something critical before you do anything else. This is not the official silver price in Japan. This is what physical buyers are being asked to pay. And the gap between that number and what you see on your screen when you check the spot price, that gap is trying to tell us something that most people are completely missing. Before we go any further, if you want to cut through the noise and understand what's really happening in precious metals, currencies, and the financial system while everyone else is getting distracted by headlines, hit that subscribe button right now. This is the Wealth Continuum, and we're building a community of people who see what's coming before it arrives. And real quick, drop a comment below and let me know where you're watching this from, because what's happening in Tokyo right now might be a preview of what's heading to your country next. So let's get something straight immediately. When you hear that silver is trading at $130 in Japan, your brain probably does one of two things. Either it thinks this is fake news, some kind of scam or misunderstanding, or it thinks the silver market is about to explode everywhere, and you need to buy right now before prices moon. Both reactions miss what's actually happening. And what's actually happening is way more important than either of those narratives. The spot price of silver, the one you see on financial websites, the one that COMEX and the futures market determine, that's been hovering in a very different range. We're talking mid to high 20s, maybe low 30s depending on the day. So how do you get from $30 to $130? The answer is premiums, physical premiums. And this is where the story gets interesting, because premiums aren't supposed to behave like this in a functioning market. A premium is the markup you pay above the spot price when you buy physical metal. It covers minting costs, dealer margins, shipping, insurance, all of that. In normal times, premiums on silver rounds or bars might be $2, $3, maybe $5 an ounce. Sometimes a bit more for coins with numismatic value. But we're not talking about $5 here. We're talking about premiums of $70, $80, even $100 over spot in some reported cases in Japan and parts of Asia. That's not a premium anymore. That's a completely different market. Now, why Japan? Why now? Japan has always had a strong culture of precious metals ownership, especially among older generations who remember economic instability. But there's something else happening. The yen has been under serious pressure. The Bank of Japan spent decades with negative interest rates, and even as they've started to shift policy, confidence in the currency isn't exactly soaring. When your currency is weakening and you don't trust your central bank's ability to manage inflation, you look for hard assets. And in Japan, that often means gold and silver. But here's the thing. Japan doesn't mine much silver. They import it. And if you're importing silver while your currency is falling, you're paying more in yen terms even if the dollar price stays flat. Add to that the fact that global silver supply has been tight. Mints around the world have struggled to keep up with demand, and dealers have inventory issues. And you start to see how premiums can spiral. But even accounting for all of that, the numbers coming out of Tokyo are extreme, and that tells us there's more going on beneath the surface. Some people are calling this proof that the paper silver market is a fraud, that the real price of silver is being suppressed by big banks and futures traders, and that physical metal is revealing the truth. And look, there's a conversation to be had about whether COMEX pricing accurately reflects physical supply and demand. There's a conversation about whether massive short positions from a handful of institutions distort the market. But jumping straight to silver is really worth $130. This is a more nuanced reality. What you're seeing in Japan isn't the true global price of silver. It's the price of desperation, illiquidity, and localized demand shocks. It's what happens when buyers in a specific region are willing to pay almost anything to get physical metal, and sellers know they have the upper hand. It's a symptom of a fractured market where physical and paper have started to decouple in certain areas, but that decoupling hasn't gone global yet. The key word there is yet. Because here's what should make you pay attention. If premiums stay elevated in Japan for months, if they start spreading to South Korea, Taiwan, Singapore, and then eventually to Europe and North America, that's when you know the paper market is losing credibility on a systemic level. That's when people stop trusting that they can convert their futures contracts into actual metal. That's when the whole pricing mechanism starts to break down. And if that happens, $130 might not sound so crazy anymore. Right now in the United States, you're not seeing premiums like that. You can still buy silver eagles or rounds with premiums in the single digits, over spot, maybe low teens depending on the product and dealer. The market is functioning more or less normally from a retail perspective. But pay attention to the trajectory. Pay attention to how fast those premiums have climbed in Japan, because markets don't break slowly, they break all at once. And the warning signs show up in the places where stress hits first. One of the reasons the Japanese situation is getting so much attention is because of social media and alternative finance channels amplifying the story. Videos and posts showing receipts from Tokyo dealers with eye-watering prices, and some of that is legitimate documentation of what's happening on the ground, but some of it is also being used to drive fear and urgency, to get people to buy silver right now from dealers who benefit from that fear. So you have to filter the information carefully. Ask yourself, is this person showing me data to inform me or to sell me something? There's also a monetary policy angle here that doesn't get talked about enough. Central banks around the world have been buying gold at record levels. Not silver, gold. But silver has historically been the poor man's gold, the accessible alternative for people who can't afford to stack gold bars. And as trust in fiat currencies erodes, as inflation stays stubborn, as geopolitical tensions rise, more and more regular people are turning to precious metals. That's a demand story that's real and growing. But it's not the same as saying the price is about to explode overnight. Here's the part that's going to frustrate people who want a simple answer. The truth is that silver is both undervalued relative to its industrial demand and historical ratios to gold, and also not about to hit $130 everywhere, just because it did in one city under specific conditions. Both things can be true. The market can be manipulated and distorted by paper contracts, and also not on the verge of an immediate moonshot. The Tokyo premiums are a data point, a significant one, but they're not the whole story. What they do tell us is that physical delivery is becoming harder in certain markets. That there's a growing lack of trust in the financial system, its ability to deliver metal when it's needed. That people with wealth in unstable currencies are scrambling for alternatives. And that the infrastructure of the silver market, the mints, the dealers, the refiners, the logistics networks, is not built to handle a true stampede. If everyone who owns paper silver decided they wanted physical delivery at the same time, the system would collapse. It's not designed for that. It's designed on the assumption that most people will never ask for delivery. So what does this mean for you? If you're in the United States, watching this from a relatively stable currency environment, at least for now, the Tokyo story is a warning, not a call to panic buy. It's a reminder that the gap between paper and physical can widen fast. It's a signal that you should have at least some exposure to physical assets before the crowd realizes they need them. Because once premiums start spiking in your local market, you've already missed the easy entry point. But it also means you should be skeptical of anyone telling you to dump everything into silver today, because it's definitely going to $130 everywhere next month. Markets are more complex than that. Premiums can spike and then come back down if supply catches up or demand cools. And there's a big difference between a regional supply crunch and a global monetary collapse. One is a trading opportunity, the other is a civilization-level event. Don't confuse the two. Now let's talk about what Wall Street thinks of all this, because the reaction from mainstream finance has been pretty telling. Most analysts and institutions are dismissing the Tokyo premiums as an anomaly, a local inefficiency that doesn't reflect true value. They'll point to the futures market, to the fact that you can still buy and sell silver contracts at much lower prices, and say that's the real price. And in a sense, they're right. The futures market is liquid, it's global, it's where price discovery happens for most commodities. But futures markets also rely on trust that the exchange will honor contracts, trust that there's enough physical metal backing those contracts if everyone wants delivery. And that trust isn't infinite. We've seen this movie before with other commodities. We saw it with oil when prices went negative in 2020 because of a mismatch between paper contracts and physical storage. We saw it with nickel on the London Metal Exchange when a short squeeze forced the exchange to cancel trades and halt the market. These aren't theoretical risks. They're things that have already happened in major global markets. And if it can happen with oil and nickel, it can happen with silver. The difference is that silver has a monetary component that most industrial metals don't. People don't hoard oil in their basement as a hedge against currency collapse, but they do hoard silver, and that dual nature, industrial commodity and monetary metal, creates unique dynamics. When the monetary demand kicks in hard, when people stop seeing silver as just a material for solar panels and start seeing it as money, the price behavior changes. And we might be in the early stages of that shift. Here's a question you should be asking yourself. If the COMEX silver price stays at $30, but you can't actually buy physical silver for less than $60 or $70 anywhere in the world, which price is real? The one on the screen or the one you have to pay to get metal in your hand? This isn't a gotcha question. It's a fundamental issue about what price discovery even means in a world where physical and paper markets are diverging. And this brings us to the bigger picture. The Tokyo silver premiums are part of a larger story about trust, about the cracks forming in the global financial system, about what happens when people start to question whether the numbers on their screens represent reality. It's happening with silver. It's happening with gold. It's happening with real estate and equities and bonds. The gap between the official narrative and what people experience in their daily lives is getting wider, and precious metals are one of the places where that gap becomes measurable. So where does this go from here? One possibility is that Japanese premiums come back down as supply adjusts and the initial panic fades. Dealers bring in more inventory, mints ramp up production, and the market normalizes. That's the optimistic scenario. The other possibility is that this spreads, that premiums start climbing in other countries, that more people wake up to the idea that physical metal might not be available at paper prices when they actually want it. And if that happens, we could see a cascade where the entire pricing structure breaks down and resets at a much higher level. Nobody knows which of those scenarios plays out. Anyone who tells you they know for certain is either lying or delusional. But what you can do is prepare for both. You can recognize that there's value in holding some physical silver, not because you think it's going to $130 next week, but because it's a form of wealth that exists outside the banking system, outside government control, outside the digital ledger, and in a world where trust in institutions is eroding, that has value regardless of the spot price. You can also recognize that timing matters. Buying physical silver at a $100 premium because you're afraid of missing out is probably not a smart move. But having a position already, or adding to it when premiums are still reasonable, that's a different calculation. The time to prepare for a crisis is before everyone else realizes there's a crisis. By the time the mainstream media is talking about physical silver shortages, you're already late.